The second reason why these changes could, in my opinion, be a double whammy for some families relates to the present inheritance tax allowances. In addition to the basic inheritance tax allowance, there's an additional allowance known as the residence nil rate band, which is an extra £175,000, which can be set against the value of your residence if you leave it to direct descendants. So for a couple, this can be an extra £350,000 of allowances if they have a property that's worth £350,000 or more. However, there's a provision in the rules which says that for the very largest estates, the residence nil rate band is reduced on a sliding scale. I think the idea behind this is that the allowance was originally introduced to compensate for the fact that families were getting drawn into inheritance tax simply because the value of their residence had increased over time while inheritance tax allowances hadn't. And what it basically says is that if an estate is worth more than £2 million, then that's when the allowance starts to be tapered down. So what that basically means is that if somebody has a significant pension pot and this is brought into their estate and takes them above the threshold, then not only will the pension pot itself potentially be subject to inheritance tax, but it could also have the effect of reducing the inheritance tax allowances that the estate's entitled to generally. So what I'm saying is, in effect, families could find that the pension means that the actual rate of inheritance tax that their estate is subject to turns out to be rather higher than they were expecting. So there are three important takeaways from this. The first is that many people will have arranged their inheritance tax affairs over the last few years on the assumption that their pensions will be outside their estate for inheritance tax purposes. As a result of the recent budget, we can't now assume that as from 2027 that's going to be the case. So if you have a pension pot, it'll be very important to review the advice you previously had and to take further advice between now and 2027 to make sure that any changes you need to make can actually be made. The second point is the point I've already made about the fact that the devil is in the details, to use the terrible old expression, and the precise proposals are not entirely clear, which is another reason why we'll need to keep this under review as we move forward towards 2027. And the third very important point is that both pensions and also inheritance tax are complex subjects where the precise advice can depend very much on individual circumstances. So if you think that any of this might be relevant to you, it's important to take your own advice in relation to your specific position.